Many out there watch what Warren Buffett does, and rightfully so. He is one of the most successful investors of our time. Currently, Warren Buffett, though, he is selling. He sold $97 billion in holdings and bought only $4.3 billion in new purchases. Buffett believes in taking a profit when the market is high to build a war chest of cash to buy at lows. The old adage of buy low, sell high. What should that signal to the person right on the edge of retirement that's trying to preserve their nest egg?
Well, I've been talking about this a little bit here on the past couple of different shows about what I would refer to as downside risk management. If we take, the markets in the most simplistic form, it's buy low, sell high. You have a
Hmm.
market that's overall at, fairly record level highs. When we did our economic summit a couple of weeks ago, we shared a little bit about what our outlook was on the market moving forward. I think the first thing that you need to realize is we've had two great back-to-back years in the market. And even though that the market is at record highs, if you look at some of the historical numbers and look at the S&P 500 index and you think about how many times has the S&P 500 index experienced three or more consecutive positive years throughout history, when I was doing my research, I came up with 16 different times that the market posted three or more positive consecutive returns in the S&P 500 index from 1926 to today. And in fact, you've got some of the longest streaks were in the 20s, the 80s, and 90s, and each of those lasted for 8 or 9 years. So the problem here is investors can get emotional and they can make these emotional decisions that lead them to try to get in and out as well as chasing results. We had a segment earlier where we were talking about gold and how it's now a more popular topic after the markets have already run up. So what you don't want to do is you don't want to maybe abandon ship if you're looking at the equity markets. You want to know if and when the market has a downturn, what is your downside risk management program in place? It's no different than what we taught our kids when we were little of running the fire safety drill. If you have a financial advisor or if you're doing it on your own and you are not running the fire safety drill and understanding clearly what is your downside risk management system, you could be the type of investor that are at risk. You could also be the investor that's at risk right now if you're thinking, the markets are great. I'm just going to pour more money back into equities and chase this market. That's also a dangerous strategy to do as well. In developing it, what you have to do is you have to really understand what is your methodology, your philosophy, understand where there are opportunities overall in the market, what type of sectors maybe will perform well, whether Democrats or Republicans will win, and maybe slightly tilt the portfolio. But again, if you look at the time on your side, the more time that you have on your side, the more that I would say it's the time being invested. The challenge is for those folks that are getting close to or in retirement time, which is predominantly what we work here with at America's Retirement Headquarters, they cannot afford the luxury of taking major losses if and when the market went down. And, luckily in COVID, what happened is you had the federal government bailed everybody out, including Wall Street. So there was trillions of dollars that were spent to push the market back up. With either this administration or where the elections go, if we have something that happens like that, you have to ask yourself, will Washington bail out Wall Street again? Because had they not the last time, it could have been catastrophic for equity investors as well. And so, although things appear good right now, history would tell us that there can be a shock to the system that can make things turn in a hurry. And even though there's been those numerous times that you've had, market returns for more than 2 years, history would also tell us that when downturns happen, they happen in a hurry. Think about how fast the equity markets fell in COVID, how fast they fell in 2000, or how painful it was, in 2008 in those different environments as well. That is why, in my opinion, it's so crucial right now to be optimistic, to be positive, to be able to be in a position that you can take advantage of the markets going up, but knowing what is your downside risk management. That's what I continue to promote for folks that I meet with. Dave, what's your opinion about market conditions right now?
If you find yourself paying a lot of attention to the political advertisements that are on TV and radio promoting or taking a shot at certain candidates. I think the overwhelming theme that a lot of people would agree with is that it's more of a situation where I'm trying to say that this guy or this lady is not a good candidate and you should not vote for them. They kind of prey on the gloom and doom scenario. So if you find yourself listening to all of this stuff and having opinions about who should be elected, who should not be elected, that could cause you, in regards to your investment portfolio, to get a little jaded and maybe think, oh, this is the great time to get out of the market. We don't know what's going to happen. Well, what do we know it's going to happen? The election is going to happen. There's going to be people elected. We also know historically that when we have a divided government where there's Republicans and Democrats, that's generally pretty good for markets because there's some gridlock. When one party has control, sometimes it can get a little bit interesting. But, how should I invest in 2025? Interest rates are dropping. We have a political climate that's going to eventually, it's going to be very clear who's going to be leading our country moving forward. Americans like certainty. Financial markets like certainty. So I don't think this is the time to just say, oh, I need to get out because things are going to get dicey. But if you work with us here at America's Retirement Headquarters, you will know that you have a dedicated team that's overseeing the investment models that your money has been allocated into, and we're going to make recommendations and we're going to make rebalances within our portfolios that are going to take advantage of the economic realities that present themselves as we move down the road.
Knowing when to pivot and how to pivot could be easier said than done for people who don't do this for a living. Nolan, as you pointed out, 50 combined years of experience right here at the table alone. So if you have questions or possible concerns, if you see what Warren Buffett is doing and you think to yourself, maybe I should follow suit. Again, the man kind of does know what he's doing, but you want to figure out how it works for you. Set up a time to speak with the guys at America's Retirement Headquarters. It's real easy to do. You can go to the website, find out more about them, and set up a time there at arhq.com. Or you can give a call. That's 419-794-3030.